Thanks so much to the organizers for having me. It's never easy to discuss your co-author's paper, but I'll just pretend to be like Serena versus Venus Williams in the finals of the U.S. Open. They're no friends at that point. So this paper sort of fits in long literature and asset pricing thinking about incomplete markets, the distribution of wealth and how it affects asset prices, right? And this is pertinent because wealth is extremely concentrated. Equity wealth, as Tim showed us, 90% of equity wealth is held by the top 10%. And within those very wealthy portfolio, a lot of it is idiosyncratic risk. There's a lot of own business wealth. There's a lot of private equity, venture capital type of exposure, right? And this has implications for asset pricing, right? Sort of the marginal investor should, the asset prices should reflect the preferences and the constraints of those marginal investors who are these under-diversified rich. And that has a long tradition in asset pricing, for example, all the way back to Annette Vissing-Jurgensen's job market paper. We've been studying Euler equations of stock market investors, pointing out that their consumption growth is more volatile, it's more correlated with aggregate stock returns. We also know that sort of in the financial crisis, for example, the rich were affected much more from the decline of stock prices. We know that from Jonathan Parker and Annette Vissing-Jurgensen's paper. The work by Chen, Cole, and Lustig has been thinking about different types of investors, and in particular that there's a small share of investors that are bearing a disproportionate share of the amount of aggregate risk that affects asset prices. And sort of more recently, there's some interesting work on demand-based asset pricing that has been looking at the portfolios of the rich. I'll come back to that data later, and that has pointed out that during COVID, when a lot of the merely rich in the 8th and in the 9th deciles of the wealth distribution wanted to sell their shares, it was the very rich that were absorbing these stocks, and that required large price concessions to be willing to do so. So sort of more generally, there's sort of this large literature on heterogeneous investors and imperfect risk sharing. And what we've learned from that literature is that the cross-sectional distribution of wealth matters for asset prices. Now, this requires one important assumption, which is that idiosyncratic risk has to be correlated with the aggregate state of the economy. We know from Kruger-Lustig that if it's not, then essentially idiosyncratic risk does not affect risk premia. And so the mechanism here, the key mechanism here is that firm idiosyncratic risk is becoming much larger. The volatility of those firm idiosyncratic shocks rises in aggregate disaster states. There's sort of a second mechanism going on here that Tim didn't emphasize, but labor income shocks, their skewness is also rising in disasters. That's sort of a second source of correlation. And in fact, these two sources of idiosyncratic risk are correlated with each other. That's sort of a third mechanism. Now, we know that indeed, if you break this relationship between idiosyncratic and aggregate risk, then, for example, from Constantinides and Duffy, the cross-sectional variance of consumption growth becomes a factor in the stochastic discount factor. In fact, it need not just be the second cross-sectional moment. Braff, Constantinides, and Gaethje shows that the third moment, the cross-sectional skewness of consumption growth, is a price risk factor. Right? And so these type of mechanisms have been built into full-fledged asset pricing models to show that, indeed, you can sort of generate larger risk premia through these mechanisms. So where does this paper come in? It sort of makes an important contribution to this literature by, first of all, bringing in production. And we know from the production-based asset pricing literature that once you allow firms to make choices, then they're going to be absorbing a lot of that aggregate risk. And it actually becomes much harder to generate an equity risk premium, right? And so you're going to need frictions to fight that force. And so the key friction here is sort of an equity issuance cost friction. So then sort of the second key contribution is that the paper sort of very cleverly sets up the model so that there's aggregation. And this is non-trivial because it sort of requires a lot of pyrotechnics to get to that result. Sort of the key assumption is that all the idiosyncratic shocks are IID. Okay, so that's very important. It cannot be persistent, otherwise you lose this aggregation. But there's sort of this beautiful aggregation result that, in my mind, sort of substantially generalizes Constantinides and Duffy's result. Sort of to the setting with production. I should also mention that there's sort of full-fledged dynamic capital structure going on here in a general equilibrium model, which is not obvious. And then the third point is that under-diversification here is optimal, right? So people are choosing to hold a concentrated portfolio because of these two key forces. There's income that comes from managerial effort, and there's private benefits of control, this psi parameter. And I think the paper estimates identifies and estimates these moments, and I think these are of independent interest to the literature. And then finally, there's a sophisticated global numerical solution technique here that Tim sort of glossed over, but there's 3 endogenous state variables here, 2 exogenous state variables, the wealth distribution, matters, and there's occasionally binding firm financial constraints, so all of that sort of requires a global numerical solution technique. So what do we get for the price of all of these assumptions? Well, sort of a lot of progress. We get to match all of our traditional asset pricing moments, the equity risk premium, the risk-free rate, their volatility, conditional moments about stock return predictability. We match a return on a fully concentrated private firm for the observed amount of portfolio concentration with realistic implications for macro aggregates, with realistic firm capital structures. Again, Tim skipped a lot of this, but equity issuance rates, payout rates, leverage rates, both the means and the volatilities of all these things are matched in the model for a modest amount of risk aversion with a low intertemporal elasticity of substitution, which most macroeconomists would prefer, and with moderate disasters, sort of compared to the disaster literature. So there's sort of four key parameters here that are identified by four key moments in the data, and sort of my first comment will be about that. So let me just sort of show you a graph from the paper that Tim skipped, but sort of what are these four key parameters that are identified by four key moments? Well, they're the amount of idiosyncratic firm volatility, sigma bar E, risk aversion, sigma, and those two sort of are uniquely pinned down by the share of idiosyncratic risk for the fully concentrated portfolio and the equity risk premium. And you can sort of see these loci of points, they sort of uniquely pin down these two parameters. And then the next two sort of key parameters of these four parameters are that psi parameter, that's the private benefits of control, and the alpha zero, which is the managerial effort share. Right? And those are uniquely pinned down by the share of idiosyncratic risk for the portfolio that's held in equilibrium and the idiosyncratic risk premium. The fact that if you hold a fully diversified position, you need to earn a 6.7% higher return than on the equity market. Okay, so those are sort of the four key moments that I want to spend a little bit of time talking about because, sort of by virtue of this identification, if you move the targets around, you're going to be moving the parameter estimates around, and sort of as a result, the implications of the importance of idiosyncratic risk for the equity risk premium. So these are sort of the four key moments. So let's talk a little bit about those moments. So what does the paper do? The paper sort of says, look, it's not easy to pin these data moments down, and I'm very sympathetic to that. So at the end of the day, we sort of need to talk about the top wealth, what's happening at the top of the wealth distribution. So it uses 2019 Survey of Consumer Finance data to sort of pin down the share of the portfolio that's idiosyncratic. And in that calculation, it treats private equity and venture capital as sort of fully concentrated, part of the private equity component of the portfolio. Because if we didn't do that, if we just included people's own company stock, we would sort of have to calibrate to a 10% share rather than a 45% share of private equity. So that would be sort of a big difference in the target here. So what about the private equity return? Remember, it sort of calibrates to a 13% return on a fully private position. Where does that 13% number come from? Well, folks in the SEF are basically asked, what do you think is the return of your private business? Now, when I asked myself this question, I thought that's a really hard question. Imagine I asked you, what's the return on your private consulting business last year? That's a hard thing to come up with, right? So 13% is what they said, but in that and then sort of who knows where that number comes from. But then in addition, that sort of excludes the private equity VC fund returns that are part of the share in the first step. So there's sort of a slight inconsistency here in these targets. So then the other two moments are these idiosyncratic variance shares, and there it goes to Sweden to sort of study, to what extent the very wealthy in Sweden bear a lot of idiosyncratic risk. So that sort of raises the question: do the Swedes have similar own business risk? Do they have similar private equity or venture capital portfolios? I don't know. It's a very different sort of society, especially at the very top of the wealth distribution. Right, so I want to argue that sort of there's better information on holdings and returns that has to sort of become recently available from this ADEPAR data that I think could help the authors sort of inform these four key moments. So I took a quick look at these ADEPAR data. So they're sort of in this Ballock and Rogers paper, as well as in this Gabex, Koyen et al. Paper. So it's actually a terrific data set. There's a lot of rich people in it. 40,000 people in the top 1% of the wealth distribution. In the SCF, there's only 700 people. It even has 118 people that have a single position with that's worth more than $1 billion. So what do the portfolios of the rich look like in the US? Well, it's a little hard to read, but this is people over $100 million. These are people below $3 million. So remember, 3 million is sort of the cutoff to be in the top 1%, and 80 million is sort of the cutoff to be in the top 0.01%, right? So this is public debt and public equity. This pink is alternatives, VC, private equity, hedge funds. And then this orange bar is your own business. Right? So sort of the first point that you see right away is that if we strictly interpret this sort of fully diversified position as your own business, there's fairly little own business wealth in the data. Even among folks that have more than 100 million, this is sort of a fairly small sliver. Now, once we add their alternatives, and we add their real estate, and we add some other assets, their cryptocurrencies, whatever else is in here, then maybe we get to like 50% of private wealth, but only for the very richest. Right? So remember, the paper sets this number to 46%. So to get to a number like 46%, you need to include a lot of categories of wealth, in particular alternatives, maybe even real estate, and you need to be focused at the super wealthy, not just at the top 1%, but sort of at the top 0.001%. The second thing we learned from this IDPAR data is that the returns that these folks are earning are sort of surprisingly low, only about 4%. Versus, this was for 2016 to 2022, the stock market had an 11% return over this period. So this is sort of a puzzlingly low number. Also, interestingly, the slope in wealth is only about 45 basis points, and the arithmetic mean only about 30 basis points. So if we think of the very wealthy as we sort of increase wealth as increasing the degree of under-diversification, the extra compensation for that does not appear to be particularly large. Arguably, it's a short sample, but still it's sort of much smaller than the 6.7% idiosyncratic return premium that the paper calibrates to. Right? So basically, the data series matters. The paper calibrates to this Xavier paper from the Survey of Consumer Finance that has a much larger gap in return between the wealthy and the not so wealthy than what this data suggests. And then for the idiosyncratic risk share, something else that's sort of interesting is that in the Swedish data that the paper calibrates to, the very wealthy have much more portfolio volatility, 2 times more, even at the very top of the wealth distribution. Whereas here, we see that the volatility is actually falling in wealth. Okay, so that's sort of an interesting and surprising result as well. And that's mostly coming from the fact that the very, very rich are holding more private businesses. The very rich have maybe 3 private businesses instead of 1. They have maybe 10 private equity funds instead of 1. And that actually helps them diversify their portfolio quite a bit. Okay? So sort of what are the lessons of all of this for the paper? I think sort of the total share of equity held as an under-diversified position appears sort of smaller than 46%. Except for the very wealthiest and except if we include alternatives. I would argue conceptually, alternatives should be part of the public market portfolio. If we only have 2 assets, private and public, then sort of the PE portfolios is the way in which the rich lay off the risk to the rest of the market. So that should be part of the market portfolio, not of the concentrated part. Right? So once we do that, we end up with a much smaller private wealth share. And then sort of the return slope and the risk slope are in these data that I showed you, arguably smaller than the targets that the paper picked. Okay, so that's sort of my first point. My second point is about, I think there's sort of an opportunity here for a follow-up paper, which thinks about secular changes. Right, so this is sort of calibrated to the post-war history, but a lot has changed that's relevant for this paper in the last 40 years. So in particular, there's a lot more top wealth inequality now. There's a lot more top income inequality. There's much lower interest rates, and there's also much more stock market participation. And I think sort of all these trends are potentially connected to each other, and sort of the paper could run with these changes and sort of see what they mean for risk premia, right? And so potentially these changes are correlated with each other. So, for example, in Favilukis' paper, he sort of tries to explain this rise in participation in the stock market and argues that this results in a decline in the equity risk premium. And sort of one other paper that's potentially pertinent here is this job market paper by Magnus Erie that argues that opportunities for entrepreneurs to lay off their idiosyncratic risk have sort of structurally improved in the last 30, 40 years, through the rise of the venture capital and the private equity industry, right? And so you could it's intuitive. If I give these entrepreneurs more opportunities to lay off their idiosyncratic risk, that's going to lead them to diversify their portfolios better. But it potentially also allows them to scale up more, right? They can issue more equity along the way to these VCs, and that can sort of lead them to grow their businesses larger. And that scale effect dominates if these entrepreneurs can easily capture market share from traditional sectors. So that sort of results in an increase in top wealth inequality over the last sort of 30, 40 years as this VC sector has grown. Right? So I think these are all sort of interesting opportunities for the paper to sort of connect better to this top wealth and income inequality literature, maybe enriching the model a little bit, maybe introducing a group of hand-to-mouth workers, a group of passive diversified equity holders, and then to ask, what happens in our models secularly over time as we lower the cost of passive stock market participation, the cost of laying off idiosyncratic risk. My last comment is a very small one. I'm going to skip it in the interest of time, but I think the paper could do a better job sort of connecting their stochastic discount factor to that earlier literature that looked at cross-sectional variances and skewnesses of consumption growth as factors in the distribution, as factors in asset prices. So in conclusion, this is a beautiful paper. There's a lot going on here. I think it breaks sort of substantial new ground on a classic asset pricing question. What's the importance of imperfect risk sharing for key asset pricing moments? And I'll leave you with my suggestions.